Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today, we'll explore how small business owners can more effectively use Creditor Tools, specifically Refinance Risk. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Refinance risk is when or how likely a debtor is to default on its loan because it is unable to refinance an outstanding balance when the loan comes due or matures. Obviously, this means that there has been a serious material deterioration of its financial condition and where other creditors may not be willing to accept the increased credit risk through a refinance. It can also mean that because of changes in interest rates, like they increase, right? And changes in underwriting criteria, they're more conservative. The borrower is unable to meet the new requirements upon maturity. Okay? Continuing this very high credit or refinance risk. The debtor can't refinance and is struggling to repay as it is. This could possibly lead to payment default and collateral liquidation or higher refinance risk. Also, the property's value may become reduced and make it even more difficult to refinance. So lenders are going to be paying close attention to the earlier resizing opportunities before refinance risk increases too far. They'll be closely monitoring interest rates and market conditions, borrower creditworthiness, upping guarantees possibly, or maybe even asking for additional collateral. Lenders will determine if outside financing is even possible, if the loan needs to be downgraded and extended with disclosable modification terms, or the collateral even be sold. The borrower may take measures to improve its creditworthiness and even the property value, or reduce the debt levels on its own, increase their cash flow, or obtain additional interested guarantors, provide more collateral, or up their guarantee percentage, offer and negotiate a workout or loan modification. Specifically, these potential issues will have to be faced one way or another. But what about today's higher interest rate environment? Higher interest rates result in likely higher borrowing costs, more difficulty for the borrower to repay or obtain replacement financing, and result in a higher likelihood of default and foreclosure. Possible mitigating strategies for managing interest rate risk is the use of interest rate swaps, exchanging a variable rate for a fixed rate. Interest rates can be capped to limit increases or maximize costs, or have floors that provide a minimum borrowing cost. What about those resizing opportunities where they pay it down, right? The lender will determine if a commercial real estate loan, for example, needs to be paid down or resized by considering various factors such as a higher interest rate environment, reduced net operating income due to decreased rents and higher operating expenses, declining economic market conditions, lower debt yield, weak forecast, poor liquidity, even uncertain repayment ability. The lender will document the case to determine if a resizing opportunity by using repayment tools like debt service coverage ratio, loan to value, debt yield, stressed interest rate sensitivity, showing how a higher interest rate will affect repayment, and propose and document a resizing paydown recommendation, if at all possible. The lender will make it clear that it is putting its interests first and the borrower's interests second. How about repricing risk? The possibility of a loan may need to be refinanced at a higher interest rate upon maturity, right? Especially in an economic downturn and high interest rate environment, rates should cover the cost of funds, loan servicing, probable loss, as well as reasonable profit margin. So this has to be taken into account. Lenders will also underwrite the borrower's creditworthiness, income, and how much the collateral value has declined. So as the credit risk increases, so does the pricing. The lender will confirm root causes behind any deteriorated financial performance, including if the borrower has lost a major client, a supplier, employee, a major contract, customer, or vendor. The refinance loan pricing will have to reflect these increased credit costs. So don't be surprised if they're talking a higher interest rate. Well, why is higher interest rate risk important to you? Well, refinance risk is a big deal. It's a very big deal and will likely result in a credit risk rating downgrade if you can't refinance like you should. Your current financial condition, market conditions, the potential timing on a refinance, and other factors may or may not be in your favor for a refinance. So don't be surprised to find your loan risk grade has been downgraded to special mention, which is a criticized rating, if refinancing is your only viable option for repayment. This is especially true if your cash flow is just nominal or marginal, where there's no likelihood of reducing the principal balance and your refinancing is or was your only option for repayment. Your loan risk grade may be lowered to substandard, which is a classified rating. Okay, a little warning for you, okay? You and about every other borrower the world over should pay very close attention to high debt levels and refinance risk. If it almost sounds like a warning, know that it is a warning. If markets were to freeze up, if interest rates jumped excessively, or any number of things, you may not be able to refinance your unpaid loans at maturity. Frankly, the world has way too much debt. It's not sustainable, and new record debt levels are here to stay as far as you can see. Not enough people are willing to even talk about this risk and how it could result in a debt crisis. For these and other reasons, you may find yourself trying to survive in seasons of default and restructuring everywhere, along with the millions of other borrowers that have really high debt levels. Please don't ever say you were not warned. Thank you for joining us. Today we covered the creditor tool Refinance Risk as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and experiences with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps other small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.